Hey, what's up guys? John here. If you want to make a fortune over the next 24 months, pay very close attention to what's happening in the labor market because it's going to restructure and change the entire workforce. And no one's talking about it. Nobody's talking about this. Now in 2021, a story was sold from the mainstream media that the Great Resignation, people deserve more.
2021 has been the year of the Great Resignation, otherwise known as the Big Quit.
Employers should offset the cost of inflation by paying their employees 20 or 30% more. And in many cases, that happened. A lot of people were able to renegotiate incredible salaries and bonuses and all these different perks and benefits, work from home. It was a great situation for employees. But now something very interesting is happening in the economy. First and foremost, in August of 2021, consumers had $2.1 trillion in excess savings, $2.1 trillion. Now they have just under $150 billion. So they went from $2.1 trillion to about $150 billion over that, call it 2-year period. Well, during this period, now consumers are burning about $2.4 billion per day. So if you do simple math, by roughly the first week of January, consumers will completely be out of money. But this does not factor in for student loans. Average payment, $504 a month. Doesn't factor in for holiday spend. It doesn't factor in for gifts. It doesn't factor in for increased utility bills and things of that nature. So with that being taken into consideration, it could be the first or second week of December, possibly third week of December, where consumers are really pushed to the edge. And so what is this going to mean? It's going to mean something very interesting and a massive opportunity for employers and employees if they're making the smart moves. And I'm going to break it down for you. I'm going to show you exactly what that is, what you should be doing, take advantage of this. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's going on in the U.S. economy. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item in your credit report, go to GreatCreditFast.com. Book a free strategy session below at GreatCreditFast.com. And if you'd like us to review your entire credit report with you, build out a game plan, strategy, tell you roughly how long this process will likely take and answer any questions that you may have because everyone's situation is different, you can sign up. It will be $1 to pull your credit report. You would be pulling it. It would be a soft inquiry. We would not be pulling it. That would otherwise be a hard inquiry. So there's no net impact to your credit report or credit score, and it would just cost you $1 that you would sign up with a credit monitoring service. You'd pay them the $1, not us, and then we'll go through everything with you. You can do it at GreatCreditFast.com. Take a look at this. So you're probably not getting a big raise this year, but don't worry. It's good for the economy, right? So they're saying this is good for the economy, that people will not be seeing, wage increases. But if you look at what's going on right now, how to find a job on Google Trends, what you're seeing is that Google Trends is showing that this is starting to really take off. People are looking for work. They're looking for work, which if you're an employer, this actually is a great thing, right? So you're going to start seeing a large pool of highly motivated and smart people that are going to be focused on having a stable job, right? So this is going to be something we haven't seen in a very long time. We've seen, the last couple of years, people being much more relaxed, having a lot of demands from their employer. That's going to change as competition continues to run more fierce. So when you look at this trend here, only one other time have we seen this higher. This is during the Great Financial Crisis at the peak. But if you look at this trend, starting right around here, you can see this trend line, and you can see that probably sometime in January or late December, we're probably going to pass Great Financial Crisis levels for people searching for jobs. Then, when you're looking here, more Americans are working 2 jobs to make ends meet, and you look at that the Fed wants to basically increase unemployment to combat inflation, you can see that the labor market's going to go through a very unique shift. And then take a look at this. So banks, credit card companies, lenders, everyone's going to be paying very close attention to this. And our economy runs exclusively off credit for the most part. If you want to finance a real estate deal, you want to start a business, you want to, get a line of credit, you want to do anything, you have to pay attention to what banks are looking at, which is this information here, because banks are likely going to continue to tighten up credit, I believe, over the next 6 months in a very big way. So first and foremost, you have credit card delinquencies rising, right? So that means they're increasing their risk lending money. And consumers have less money than they've had in a very long time. So consumers are broke and they're defaulting, right? And so consumer confidence has fallen 3 months in a row, and consumers aren't planning to splurge during the holiday season, and retailers aren't hiring as much ahead of the holidays, right? They're getting ready for this because they know that what's going to happen very soon is that consumers are going to prioritize their spending. They're going to have to start making decisions. Some of their obligations are not going to get paid, right? They're going to prioritize food. They're going to prioritize, survival first, and then they're going to start defaulting on other things that they are forced to default on. So look at the price just for consumers, right, and for food. Over the last, call it 2 years, prices have really, really skyrocketed. 3 years. Then you look at some of these numbers, right? They're saying inflation's 3%, 4%. You look at these numbers. Now, auto loan defaults are the highest for subprime borrowers. Now, pay attention to this, because subprime borrowers, I believe, are going to be the ones that are most impacted over the next 6 months. It says these credit cards have increasingly notable higher rates, analyst says. What to know before you shop. Now, you have some retail credit cards hitting 28%, some saying 30%. Then you have other credit cards around 27, 28% interest rates. So when you have a lower credit score, you're going to be forced into one of these cards. If you have great credit, in many cases you get access to 0% interest credit cards, 0% intro, 24 to 24 months, no interest, right? Every payment you make is paying off the balance. Then you're looking at what's going on with these credit cards, right? You're seeing these credit cards defaults skyrocket above great financial crisis levels. It's not even close, right? So this is how everything's about to change. October 1st, you had 43.5 million Americans that owed student loans. 43.5 million. Now, without taking into consideration these payments, consumers would run out of money in about a month and a half, somewhere in that range, right? With factoring in these payments, I'm betting that since 2 out of 3 Americans don't have $400 a month and the average payment's $504 a month, that a lot of people are going to not be able to make these payments. So if you were to just say half of these people did not make their payments, you're looking at 21, 22 million Americans that are going to default. So if they default, you have to look at what this is going to do to the economy. One late payment can drop your credit score upwards of 180 points and will stay on your report for 7 years. So now they're saying this one here, it can be as much as 180 points, right? What we're seeing, 50 to 120 points is an average, but what we're seeing with clients that sign on with us is we're seeing somewhere around 80 to 100 points as the average. We have seen closer to the 180 mark, but on average it's somewhere between 80 to 100 points. So when you're looking at the average FICO score in America being a 698, and you have tens of millions of Americans likely going to miss their payments over the next month or so, what you're going to likely see is this FICO score dropping dramatically and pushing many people into this subprime category, which that's going to be deemed the highest risk. And so as credit card companies start tightening up, what's ultimately going to happen? The people that offer the most risk are going to get the least credit. That's what's going to happen. Now, this is what I believe is going to happen that's going to be fascinating. Now, student loans, after 90 days, this will be reported on their credit report. So everyone that did not pay after 90 days is going to be reported. This will be, 90 days will be December 30th, right? But you have then Sunday is December 31st, and then Monday would be January 1. So on January 1, what I believe is going to happen is we're going to see a lot of people that are going to be checking their credit reports that week, and they're going to start seeing their credit scores tanking. And they're going to be walking into a situation where they don't have access to money, and they're basically flat broke, and they need to get access. And so what are they going to do? They're going to start disputing items on their credit report to try to fix their credit. That's what they're going to start to do. And what I believe is going to happen is we're going to see an influx of millions of people over Q1 disputing and trying to remove items on their credit report to try to fix their credit so they can get access to lines of credit. So what I believe is going to happen is I think it could possibly take longer to get results fixing one's credit, in the second quarter, the end of the first quarter, because there's going to be so many people disputing. So if you do have items on your credit report, now would be the time to start disputing. Now, when you look at what's happening here, I think this is what's going to be a huge opportunity for employers. If maybe you're an employee now and you're looking around saying, you know what, I need to work for myself, I need to do my own thing, you're going to see a massive opportunity to hire really smart people. You're going to see this, and this is why. So U.S. companies are barreling towards $1.8 trillion in corporate debt. So what this means, the $1.8 trillion corporate debt maturing over the next 2 years, Goldman Sachs estimates firms could be slammed with higher debt servicing costs as interest rates stay elevated. That could eat into corporate revenue and weigh on U.S. job market. The investment bank estimated $790 billion in corporate debt was set to mature in 2024, followed by $1.07 trillion in 2025. That amounts to $1.8 trillion in debt and maturing over the next 2 years, in addition to another $230 billion that will mature at the end of this year. Right. So what you're going to start to see is a wave of debt that will need to be refinanced could spell trouble for companies as interest rates have been raising aggressively by the Fed of last year. The Fed funds rates around 5.25 to 5.5, the highest since 2001. For every dollar spent on servicing their debt, firms will likely pull back on capital expenditures, spending by 10 cents and labor spending by 20 cents. The strategist estimates a reduction that could weigh on the job market by 5,000 jobs per month in 2024 and 10,000 jobs per month by 2025. Experts have warned of trouble for the U.S. corporations as credit conditions tighten. Already, the tally of corporate debt defaults in 2023 has surpassed the total number of defaults recorded last year. As much as $1 trillion in corporate debt could be at risk for default if the U.S. faces full-blown recession, Bank of America warned through strategists at the bank no longer sees a downturn likely in 2023. Well, 2023, many people would say that we're already in a downturn. Many people would say that they've reclassified the word recession and, we're really in more of a silent recession. People don't talk about it. You go on social media, you don't see anything about it. But when you go to the store and, you ring up a bag of groceries and you look at this half full bag of groceries and it costs you $120, that's where we're at right now. This situation is going to get much more interesting. But I believe employers or entrepreneurs or solopreneurs are going to be able to go out there and really clean up the next year or two, because you're going to see a situation where employees that had all of these high demands, those demands are not going to be met by these employers, and employers are going to be really shopping around and saving costs. So if you are an entrepreneur, could be a great opportunity to find a business partner. Could be a great opportunity to make some really big moves. I believe having a stable job today is far riskier than being an entrepreneur. Well, at least if we look back over the last 30 years. Having a stable job in the 90s, early 2000s, many people worked in one company for 10, 20, 30 years, and they had a great situation. It was like a family. My grandmother worked at a glass factory. My grandfather worked at a box factory. They worked there for 3 decades, and they couldn't have been happier. But today, if you have a job for more than 3 years or 4 years somewhere, or 3-4 years somewhere, that's a big term. It's just a different world that we live in. So I believe it's a great opportunity to start a business. There's a lot of opportunity in a changing economy. If you're in a space in which you can help people save money, make money, become happier or healthier, it's going to be a situation in which people are going to be more interested in your service. And if you have an offer that is a slam dunk win, there's no question about the value, you're going to be able to help a lot of people, and your business is going to grow rapidly by referrals. So what do you think about this entire situation? Do you think this entire labor market that we've been accustomed to over the last 12, call it 36 months is going to go through a massive change? Drop below. We'll have a conversation about this. And if you want to fix your credit, we'd love to help you. We'd love to give you a free strategy session in my company, GreatCreditFast.com. That's GreatCreditFast.com. And if you'd like us to review your credit report, you just have to sign up with a credit monitoring service. They charge $1. And Eric will spend 15, 20, 30 minutes going through your entire report with you. She'll see exactly what we can do and how we can help you, what the process will look like, roughly how long it will take. And then from there, you can make a decision. If you'd like us to help you, we'd love to. And if not, no worries, we'll cancel you. We won't charge you anything. Drop below, hit the like button, and catch you in the next video.